Stocks continue to climb today even as Washington remains in this standoff. The US government shutdown just turned 6 days old and they grow up so fast. But there's no clear sign of a deal anywhere in sight, so it could probably get a lot older. And that's what prediction markets think too, because they're already calling for a long one. Kalshi is pricing in a shutdown at around 21 days, while Polymarket gives about this 70% chance it drags on until about mid-ish October. Now that expectation alone tells us something. It tells this story where both investors and bettors both see this as more than just this political standoff, rather a potential multi-week freeze on economic data. No bueno, right? Well, I guess that's good news if you're looking from stocks' point of views. But people will be missing out on their paychecks. Now, missed paychecks are likely what will force Congress to act. The military and many federal workers are due to get paid later this week or even next week, and those first missed pay periods could become that political pressure point, just like they did during that 35-day shutdown back in 2018-2019, when even the Coast Guard went unpaid. Federal employees will eventually get back pay. Contractors won't, and unlike past shutdowns, this one comes with the possibility of mass layoffs. The White House's budget office has suggested agencies could start cutting workers outright if the shutdown drags on too long, a dramatic shift from the furlough playbook of previous years. So, that's not looking good, but for now, those layoffs haven't started. President Trump's economic advisor, Kevin Hassett, said over the weekend that if talks completely stall, layoffs could soon begin, depending on how the how that Senate vote goes. But ironically, the absence of fresh government data, this government being shut down, has been a positive catalyst for Wall Street. It's been looking really good out there. So with no new jobless claims, no payrolls report, possibly no CPI numbers on deck, there's little to really spook traders or the Fed. The Fed and the data is really what everybody's been watching. So investor optimism over more rate cuts have powered both gold, stocks, Bitcoin, all the above higher to start off this trading week. Today we've seen the S&P 500 rise 0.4%, marking its 32nd record close of this year. The NASDAQ up 0.7%, notching its 31st record high. The Dow did slip down today. It fell about 0.1%, so almost flat. Gold hit another record high. Bitcoin broke over $126,000. This is like monumental. So all new records across the board, and some are calling this gold and Bitcoin trade more of this growing debasement trade where investors are hedging against currency erosion through non-fiat assets. And the irony here is that the longer the shutdown lasts, the less data the Fed has to guide its October decision, meaning the market is essentially steering blind. And traders are now pricing in 2 or more cuts for the rest of this year. 2 to 3 is the sweet spot. Almost fully convinced the Fed will move again later this month at their FOMC meeting, October 29th. And beyond Washington, there was another big headline that really moved markets today, a major story. It literally fueled the optimism just to begin the day off, with OpenAI and AMD announcing a multi-billion-dollar partnership for AI data centers, which is one of the biggest moves in the semiconductor space all of this year. OpenAI is committed to purchasing 6 gigawatts of AMD's I don't know if this is M1 450 chips or MI 450 chips, and in return, it will receive warrants for up to 160 million AMD shares, priced about at 1 penny per share, about 10% of the entire company of AMD, and they're just at 1 cent per share. Now, this deal marks AMD's largest, biggest, hugest win yet against NVIDIA's dominance in the AI hardware, and the first gigawatt is set to come online in the second half of the next year. And it's a signal that the AI boom just isn't over, it's evolving, and a lot of people see that as optimistic because the AI trade is kind of what's lifting all tides right now, lifting A rising tide lifts all ships, so that's what's lifting ships in a way, along with this optimism around the Fed potentially cutting rates and where the data is going and everything. But not everyone's really celebrating this. You could view this one either way, but billionaire investor Paul Tudor Jones came out and let us know what he's thinking, and he says this setup reminds him of October 1999, right before the dot-com bubble's final surge. All the ingredients are in place, he said, and you have to position yourself like it's the late 1999. And back then, the NASDAQ nearly doubled. It nearly doubled in just 5 months before crashing. And the point here that Jones was making is when the market runs on narrative and easy money. I don't know if you've been watching any of my videos or any news articles lately, but easy money in this narrative and faster than anyone expects, it often happens to go further. This like blow off the top kind of bet. And he warned that this bull run could still have juice left in it. So he's not calling for this immediate crash, but like in every late cycle rally, the end tends to come super fast, super quick once the sentiment flips and that narrative changes. Still, like I said, Jones isn't calling for this immediate crash, but just be aware, everybody. Like, think about like GameStop and AMC back in the day, where how fast those meme trades happen. I'm not saying like the entire stock market's this huge meme trade, but euphoria is euphoria, and fear of missing out and easy money and margin and all of the other factors right now, like Paul Tudor Jones, not just Joel, like I'm just reading what I'm hearing from this hedge fund billionaire. He's saying just be aware. And in so many ways, he's right. We got valuations being high. Like I said, leverage is rising. Investors are fully loaded into equities, yet the Fed is still cutting rates. The government is still spending. And that's the kind of fuel that can push markets even higher until, well, it can't. And then meanwhile, in other news, we got Morgan Stanley's Mike Wilson saying this isn't anything like 1999 overall. So this is a complete different twist. And he's arguing that these high valuations are justified. So his team's analysis really shows that this corporate America's free cash flow yield today is roughly 3 times higher than that of the dot-com bubble. And when you adjust for stronger margins and profitability and such, the market's price to earnings ratio, that PE, is actually trading at a 40% discount to where it stood back in 2000. So he's saying valuations aren't as bad as a lot of people are making them out to seem, and it's not comparable to that dot-com bust. Which is funny that, anyways. So what Wilson sees is that this is an early phase of an earnings recovery where he thinks the so-called rolling recession is ending and that we're coming out of that, and that companies are about to benefit hugely from easing labor costs. And he's also pointing out that inflation, while a concern for some like members of the Fed or some who see Trump's tariffs as being this huge inflationary force that sticks around for longer than a lot of people's expecting, can actually help corporate profits by boosting both the revenue and pricing power of these companies. And what that means is that inflation isn't necessarily bad for stocks, and in his view, this setup is the start of this multi-year earnings expansion, not the end of a cycle. And when earnings expand, usually the stock prices do too. But Fed officials have spent the day sending mixed signals. So once we get into, let's go on to Kansas Fed President Jeff Schmid, who says rates are appropriately restrictive and that cutting too much could reignite inflation. So he's part of the inflation still a problem camp. And he emphasized that durable goods prices are rising again after 30 years of declining, which is this huge... Did I read that right? 30 years? Which is this red flag in that inflation expectations are the result of Fed decisions and not the input. Then Dallas Fed President Lori Logan, she echoed that caution, saying policymakers must avoid overstimulating demand in an economy where the labor market remains balanced. She called non-housing services inflation worrisome, and then we heard from Vice Chair Philip Jefferson on Friday, and he took this more balanced stance. He supported the last FOMC rate cut we got, saying the labor market looks increasingly fragile. He's expecting inflation to resume to its deflationary path in the coming years, but admitted both sides of the Fed's mandate, inflation and jobs, are under stress, looking like this stagflationary environment a lot of people were warning of. Then Fed Governor Stephen Myron called for faster cuts, arguing that the neutral rate has fallen, and that's what's keeping policy too tight for too long, and that could be this problem that we have to deal with. And that one thread tying all together is the uncertainty, because with the government shutdown, with the Fed missing crucial data and them all being like mixed as in what they're supposed to do, they don't know what's going on with inflation and jobs and spending and the very numbers it uses to make policy decision, they just don't know. It's not there. And that means the October FOMC meeting could be one of the most data blind rate decisions in history. Right now, it looks like markets are, once we pull it up, they still see this almost 95% chance of the Fed cutting rates by 25 basis points at their October 29th meeting. And December, it looks like they're on board to see about 50 basis points of cuts between now and the end of the year. So yeah, that's kind of where we're at. So just to kind of recap out today, y'all, we've got a government shutdown that could last 3 weeks or even longer. Like, man, who freaking knows? And if we just think about who's there, uncertainty, unpredictability, you never know. So a data blackout that leaves investors and policymakers guessing, and for how long are we going to be guessing? And then markets are at record highs. A debate is brewing between those who see a bubble and those who see an early cycle boom. And then at the same time, Federal Reserve members are like split and divided on, man, what are we supposed to do at the next meeting? Like, I don't know that I want to cut. I do want to cut. Like, I don't feel comfortable not cutting. So you got both of them like arguing their points, but they don't have any of the recent data to base their thesis on. So for now, investors are choosing to dance while the music's still playing, and with no data to break the rhythm, the rally rolls on, and that's what we're seeing. So that's what I got for us today. Hope your day's awesome. Hope you have a good one. I'll see you.